Something extraordinary is unfolding. The Federal Reserve has just delivered its third rate cut of 2025, and yet the S&P 500 is still hovering right below its all-time highs. Think about that. 3 rate cuts in a single year, without a recession, without a banking meltdown, without a pandemic or any major economic crisis forcing their hand. The Fed is cutting rates while the economy is still growing, something we almost never see. And historically, every time rate cuts have happened near market highs, the S&P 500 has climbed 13.9% on average over the following 12 months. But here's where things get truly fascinating. We're watching one of the largest technological shifts in modern history unfold. AI is lifting productivity at a pace we haven't witnessed since the Industrial Revolution or the dawn of the internet. But it comes with a cost. AI is wiping out jobs. November payrolls actually show job losses, and job creation has been slowing all year. Unemployment just hit 4.4%. So the obvious question becomes, what happens when rising inflation, a weakening labor market, and an AI-driven productivity boom collide with a Federal Reserve that keeps cutting rates? Let's unpack this. This is the Smart Wealth Code, your compounding machine. Chapter 1. Why the Fed is cutting again. The labor market is deteriorating. For nearly 4 years, inflation has dominated the conversation. But the Fed has 2 responsibilities: controlling inflation and preserving employment. And earlier this year, the public learned something shocking. The government revised its employment data and admitted that last year's job gains were overstated by 911,000 jobs. That's almost 1 million jobs erased with a single revision. That revelation triggered the first cut. Since then, the numbers have only looked worse. The Fed simply has no choice right now. The economy needs lower borrowing costs to support spending, investment, and consumer confidence. Chapter 2. The contradiction. Here's the catch. Inflation is still too high. Core CPI is sitting at 3.1%, which is 110 basis points above the Fed's 2% target. Inflation is essentially signaling, do not cut rates. But the labor market is saying the exact opposite. And this tug of war is happening, while the stock market remains one of the most expensive in U.S. history. According to Bloomberg, today's valuations exceed 1929, 1965, and even the peak of 1999 during the dot-com mania. Normally, rate cuts show up during recessions or crises. 2008, 2020, not now, because even though jobs are weakening, GDP is still growing at over 3% annually. This contradiction has sparked a massive debate inside the Fed. Should they cut 25 basis points or go aggressive and cut 50? Look at the consumer data. Confidence in job stability has dropped to 34%, a multi-year low. The jobs are plentiful index has fallen 22 points in 2 years. The labor market is clearly under stress, yet at the same time, inflation is elevated, GDP is strong, and AI-driven productivity is exploding. Markets see all of this and they refuse to crack. Chapter 3. Why markets keep surging. Quantitative easing is back again, with Fed injecting $40 billion every month into the system. That's basically the economy on life support. The S&P 500 is only inches away from new all-time highs. It's up over 35% since April. That makes this one of the most powerful 5-month rallies in modern market history, comparable only to the early stages of 2009's recovery. And now, yet another Fed cut is about to boost liquidity even further. Yes, valuations are stretched, but nearly every macro factor is still pushing equities upward. Elevated inflation pushes up asset prices, 3+% GDP growth, bullish generational AI boom, extremely bullish. 3 rate cuts with more expected, bullish. New Trump-appointed Fed chair, expected to be dovish, also bullish. $700 billion per year in tech capex from NVIDIA, AMD, and others, money flooding into the economy. Quantitative tightening has ended $2 trillion annual deficit spending, inflationary liquidity boosting 13% earnings growth on the S&P 500, almost 50% above the long-term average. Tell me, in what world do markets collapse when all of this is happening at once? Short-term volatility? Yes. Trump's presence guarantees market mood swings. But long-term, asset holders are winning. Think of gold. Think of silver. Because markets understand the formula. Lower rates plus strong growth plus high liquidity equals rising asset prices. This is genuinely one of the most favorable long-term environments for owning stocks, gold, real estate, and other hard assets, possibly ever. Chapter 4, Conclusion. The third Fed cut of 2025 has arrived, and the market is gearing up for what could be a historic run into year end. So buckle up. This bull cycle isn't finished, not by a long shot. If you haven't already, hit the subscribe button down below so you don't miss the next major update. This is the Smart Wealth Code, your compounding machine. This year is far from over, and the finish could be unforgettable.